Hey guys, Luke Ellis here with Rivera Capital. On this video we're going to be talking through how to fund a deal and you know how that structure kind of comes to be and the different options you have in order to get that put together. So again, as a quick rehash for those who aren't as experienced maybe at purchasing a company, there's kind of three main categories that go into a deal. One of which is going to be your cash at close, which is typically the part that will be funded by the bank or some kind of creditor. Your seller note or fixed compensation to that seller post-closing over a period of time, and then what we refer to as the variable comp, earn-out structure, and or their salary or commissions or royalties all kind of fall into that variable comp category as we see it. Again, we try to hyper-simplify this because there's too many financial terms out there that just really mean the same thing, and so we're trying to make it unified for everybody to make it a little easier as you learn how to navigate maybe purchasing a company or if you're thinking about selling. So as you get into the three different kind of parts of a deal that can be, as far as how you finance it, the first one we'll talk about is cash at close and how that leads into the lending side of it. So you've really got two or three different options as a way to find the funding from a creditor or a bank to get that done. You can either use SBA financing that most regional and larger banks offer on a preferred basis. You can use a commercial bank funding process, which is going to be a conventional loan, kind of like what would be for your home or anything else. And then there's all these other ancillary offerings from private creditors on down, and we'll get into that a little bit more in detail. And then we'll talk through some of the kind of key points that we think are important in the seller note, and if an earnout is applicable. First and foremost, I want to note that earnouts cannot be used in SBA deals. So just remember that as you're looking at a deal that you'll want to structure that in the seller note in a different way, and we'll give you a few tips there too. So first and foremost, when you look at if you're using SBA financing, a few general rules are that the SBA requires a minimum of 10% down on that transaction. There's some workarounds that you can go below 10%. It can go higher than that if the bank that you're working with wants to have further equity put into the deal. What I'd also recommend is that every bank is different, even if they have to follow the same SBA rules. So we take our deals to as many different banks that we have strong partnerships with as we can, knowing that they may not like the industry or the type of business or the owner or who knows what it could be. And so don't think that just because one SBA bank says no, that the rest of them will. We get rejected a lot through this process for any litany of reasons. SBA is nice for an individual buyer because it allows you to put a minimal amount of equity down. And it gives the bank some comfort if there's not a lot of assets to back the deal, because the SBA will step in as a guarantor on it and essentially kind of backs that bank deal if it does fail. Some things with the SBA that I think are important to note for a buyer if you've never been through the process is, one, it's a lot lengthier in the paperwork realm. There's a lot more forms you have to fill out and get approved by the SBA. There are some very regimented rules around the SBA process, and what I mean by that is for example, earnouts aren't allowed. There's limitations around how investors can be involved in that deal that are maybe passive and or potentially active, and a litany of other items we could walk through with you if you have any questions. I think at least in Kansas City, we might be the only investment bank or broker that's read the entire SBA standard operating procedures, which was a very exciting 450-page document I read. And so feel free to reach out on that front if there's anything we can answer around the SBA process for that piece. As you kind of move down that line, or if you're more financially qualified or already own a business or have a lot of hard assets that can be utilized as collateral, you could potentially go the conventional lending route with a commercial bank where, minimum they're probably going to require 20% down. That all depends though on how many assets or how much assets are in the business that can be collateralized as well, and how much you have personally. So it's a much more of a convoluted process and I think much more specific to each bank and each client. Again, feel free to reach out and we can explain a lot of that difference to you if you have any questions, and even see if there's an opportunity to use a conventional loan. One thing that I will note, shameless plug here for Rivera Capital, but because of our deal success rate and that we've had 0 of our deals end up in bankruptcy and or in major litigation, there are several of our banking partners that will underwrite a conventional loan similar to an SBA loan because they've seen how high quality our due diligence process is and our structuring of the deal is. And so keep that in mind if we can help make some of those introductions, or if you'd like us to assist in trying to walk you through what we've done to secure some of those better relationships with those banks, we're happy to do so. And it's very difficult, quite frankly, guys, for a new buyer to, if you've never done it, to go talk the talk, walk the walk with bankers, because their whole job is to look for holes and look for credit risk. If you don't know how to really walk through that and navigate it, it can blow up very quickly with that bank, no matter how excited they are about that deal, because even though that individual banker may be very into the deal or think it's a great one to do, it could go to credit committee and blow up because somebody just doesn't like the industry it's in that's on that credit committee. So keep that in mind. That's actually been one of the most challenging parts we've seen in the last year or two, is that the banks have gotten much more stringent and much more adamant about saying no faster as they've tightened their credit requirements. So navigate that very carefully, and at the same time you may have to swing several times before you get a lender who will do the deal. As you move down that capital stack with that structure, in a seller note dynamic, we'll talk about some kind of key points there. Are one, we recommend not only on the banking, directly with that commercial lender, but also with the seller, that you defer out principal and interest payments for at least 90 days, usually 180 if we can get it. And the reason being is that allows you to get settled into the business. You don't immediately have a massive debt payment coming out 30 days after closing. And it allows all the other dynamics within the deal, for example, the working capital calculations and account transitions to occur before you have to start making those payments to the bank. So that is something we commonly structure into our deals right away and usually get a yes on. So if a bank says, no, we don't defer, feel free to give us a call and see if we can help and maybe give you some tips to get that done. And then on the seller note, there is some rules around that we can get into in detail around, and we will get into detail on using the seller note as a way to contribute to your equity with an SBA loan. So that's another big point that we want to make, is that you can structure the seller note however you want to, as long as it doesn't pay back faster than the SBA or the bank would get paid back. And we'll talk again on another video more in detail about that. Typically what we would do on a seller note, if I were just throwing out a random structure, it would be, hey, we'll put 25 to 40% of the total transaction value on a seller note at WSJ Prime or SOFR plus 2 or something like that. And what we try to really present to, and I think this is a big tip for buyers to keep in mind, is if you show that to a seller and over, say, a 7 or 10 year period they're getting paid directly from you, they're going to make usually an extra $500,000 to $1 million in interest that would go to the bank. So that's a good way to present it to a seller, and it gives them an income stream outside of that lump sum up front. Then you kind of move down to the last category that typically is going to be seen in larger deals, private equity led deals. We do it as well, but not as often. Especially when it's SBA, you can't do it, but it's going to be earnout, variable comp, royalty type structure stuff. And so what that would look like is, say, hey, if the company's doing $10 million in revenue, we'd set a target of, we'll pay that seller $500,000 each year for 2 years if the company does $12 million in revenue those first 2 years after closing. And so it's a way for you to basically put some pay for performance onto the deal and make sure it keeps that seller accountable to what they told you the company was doing and could do. You can structure that also as a royalty. Other ways to structure it into the deal where it doesn't affect cash flow relative to how a bank would look at it in the debt service coverage ratio, which we'll get into further on another video, is you can structure in salaries or kind of quarterly bonuses to that owner. You could structure in a higher lease rate than what would be normal on the building, so they get a little bit more compensation that way. So there are a litany of ways that we can get creative in order to get a deal done. And so really that's all we wanted to cover, was to make sure you understood all the dynamics of how to fund a deal. And then if you've got any questions over how to bring investors in and or other equity partners, we can definitely talk about that. That's a probably 8-hour video I could put together just on that topic alone. So feel free to reach out to us if you have any other questions, but thanks for watching today, and feel free to subscribe to our video.